January 18th, 1980. Silver hits $49.45 per ounce, an all-time record that would stand for 44 years. And two Texas billionaires, Nelson Bunker Hunt and William Herbert Hunt, are sitting on paper profits of $4 billion. $4 billion. In 1980, that's equivalent to roughly $15 billion today. They own 100 million ounces of physical silver. Another 90 million ounces in futures contracts. Combined, that's 200 million ounces, roughly 2/3 of all privately held silver on Earth. They've chartered 3 Boeing 707 aircraft to fly the metal to Switzerland under armed guard. They've convinced Saudi Arabian princes to join them. And they've driven silver from $6 per ounce to nearly $50 in just 12 months. This is the greatest corner attempt in commodities history. Two brothers from Texas, heirs to an oil fortune, who nearly controlled the entire global silver supply. And for a moment, it worked. They had the market, they had the metal, they had everything. Then, March 27th, 1980 arrived, Silver Thursday. The day everything collapsed, silver crashed from $21 to $10.80 in a single trading session. The Hunt brothers faced $1.7 billion in losses, the largest personal debt in financial history at that time. The U.S. banking system nearly collapsed. COMEX changed the rules mid-game, and the greatest corner attempt ever ended in spectacular failure. But here's what makes this story relevant today. The Hunt brothers proved that silver can be cornered, that supply is finite, that concentrated buying creates explosive price action. They made $4 billion before they lost it all. And the playbook they used, the exact strategy they executed, it's being studied right now by sovereign entities, institutions, and accumulators who watched what happened and learned the lesson the Hunts didn't. Don't get caught. Let me show you the entire story. Who the Hunt brothers were, why they chose silver, how they accumulated 200 million ounces, what went right, what went catastrophically wrong, and why this 45-year-old story might be the most important silver lesson for understanding what's happening in the market today. Because history doesn't repeat. But it rhymes. And right now, the silver market is rhyming with 1979. The story begins with their father, Haroldson Lafayette Hunt, H.L. Hunt, one of the richest men in America during the 1920s and 1930s. He made his fortune in Texas, oil. Not through inheritance, not through connections, through poker, literally. In 1921, H.L. Hunt was playing poker in El Dorado, Arkansas. His opponent, a cotton farmer named Columbus Joyner, had drilling rights to land in East Texas. Joyner was broke, desperate, and H.L. Hunt sensed opportunity. He offered to buy Joyner's drilling rights for $30,000 cash and $1.2 million in future payments. Joyner accepted. The land turned out to sit on the East Texas oil field, the largest oil discovery in the United States at that time. H.L. Hunt made hundreds of millions. By the 1960s, he was worth an estimated $16 billion in today's dollars. But H.L. wasn't just wealthy. He was eccentric, paranoid, obsessed with control. He had 14 children with 3 different women, 6 with his legal wife Lita, 4 from a bigamous marriage he kept secret, 4 more with a mistress. When he died in 1974, the family inheritance was chaos. Multiple lawsuits, competing claims. But when the dust settled, his sons Nelson Bunker Hunt, born 1926, and William Herbert Hunt, born 1929, inherited control of Placid Oil, one of the largest independent oil companies in America. Nelson, the eldest, was the gambler, self-taught, risk-taking, charismatic. Herbert was quieter, more educated, more calculating. Together, they made a dangerous combination. Nelson had the vision, Herbert had the discipline, and both had billions to play with. In 1973, everything changed. Colonel Muammar Gaddafi nationalized Libya's oil industry. The Hunt brothers had massive oil operations in Libya. Overnight, they lost access to reserves worth billions. Gaddafi seized the assets, kicked them out, and paid minimal compensation. This wasn't just a financial loss, it was a wake-up call. If a foreign government could nationalize oil fields, what else could governments do? Freeze bank accounts, seize assets, devalue currency? The Hunts, already deeply conservative and suspicious of government power, became convinced that all paper assets were vulnerable. Stocks? Vulnerable. Bonds? Vulnerable. Cash? Definitely vulnerable. They needed something physical, something governments couldn't print, something that held value regardless of political decisions. They couldn't buy gold. The Gold Reserve Act of 1933 made it illegal for USIP citizens to own gold bullion. That law wouldn't be repealed until 1974. So they chose silver, the other monetary metal, the one nobody was watching. In 1973, silver traded at $1.95 per ounce. Cheap, abundant, unloved, the perfect target. Nelson and Herbert started buying quietly, small positions at first, testing the market. Watching how prices responded, they bought physical silver, coins, bars, ingots. They stored it in vaults across the United States, and they started educating themselves. reading about monetary history, studying supply and demand, analyzing industrial uses. And the more they learned, the more convinced they became. Silver was undervalued, massively undervalued. Here's what they saw. Annual silver production in the early 1970s was roughly 250 million ounces, but annual consumption was 300 million ounces, a structural deficit of 50 million ounces every year. That deficit was being filled from above-ground stockpiles, mostly U.S. government reserves left over from World War II. But those stockpiles were finite. At some point, they'd run out. And when they did, prices would have to rise. A lot. The Hunts also saw inflation accelerating. In 1973, the Arab oil embargo hit. Oil prices quadrupled. Inflation jumped above 10%. The dollar was losing purchasing power rapidly. Nixon had taken the dollar off the gold standard in 1971. There was no anchor, no limit to money printing. And the Hunts believed this would only get worse. Silver, with its fixed supply and industrial demand, would preserve wealth better than dollars, better than bonds, better than almost any asset except gold, which they couldn't legally own. So they kept buying. By 1974, when H.L. Hunt died and released the $5 billion inheritance, Nelson and Herbert were all in. They escalated. They bought 35 million ounces of physical silver. They flew it to Switzerland on specially chartered Boeing 707 aircraft, guarded by armed ranch hands from Texas. They didn't trust U.S. storage, didn't trust U.S. banks. Switzerland was neutral, secure, and beyond U.S. government reach. This was critical. If the U.S. decided to confiscate silver like they'd confiscated gold in 1933, Swiss vaults were protected. The Hunts weren't just buying silver, they were preparing for the collapse of the U.S. financial system. And they wanted their wealth outside the blast radius. Then came the futures contracts. Physical silver was expensive to buy and store. Futures contracts offered leverage. For a small margin deposit, you could control large amounts of silver. Most traders use futures to speculate. They buy contracts. Prices rise. They sell for profit. They never take delivery. But the Hunts were different. They bought futures with the explicit intention of taking delivery. When contracts expired, instead of rolling them forward or selling, they demanded physical silver. The exchanges were required to deliver. And the Hunts flew that silver to Switzerland too. This created a problem for the market, because futures markets rely on most contracts being cash settled. Only 2 to 3% of futures typically result in physical delivery. The system functions because paper trades far exceed physical supply. But when the Hunts took delivery on massive contracts, they drained physical silver from the market. Supply tightened, prices rose, and the Hunts' strategy gained momentum. By 1979, the Hunts had accumulated approximately 42 million ounces of physical silver and controlled 90 million ounces in futures contracts. Combined, 132 million ounces. But they didn't stop there. They recruited help. Saudi Arabian princes, wealthy investors from the Middle East who shared the Hunts' distrust of paper currency and fear of U.S. dollar collapse. Together, this group held an estimated 200 million ounces by late 1979. That was roughly 69% of all silver futures contracts on COMEX. 2/3. They had cornered the market, and prices reflected it. In January 1979, silver traded at $6.08 per ounce. By September, $11. By December, over $20. By January 17th, 1980, $49.45. The highest price in history at that time. An increase of 713% in 12 months. The Hunts were winning. Their paper wealth hit $4.5 billion, and silver was becoming a household name. The impact was everywhere. Jewelry stores raised prices. Tiffany & Co. took out a full-page ad in the New York Times on March 26, 1980, condemning the Hunts. The ad read, "We think it is unconscionable for anyone to hoard several billion, yes, $billion worth of silver, and thus drive the price up so high that others must pay artificially high prices for articles made of silver, from baby spoons to tea sets, as well as photographic film and other products. People melted down family heirlooms. Silver burglaries skyrocketed. Doctors struggled to afford X-ray film, which used silver. Industrial users panicked, and COMEX, the New York Commodities Exchange, faced a crisis because the Hunts kept taking delivery. And COMEX was running out of silver. Here's the problem. COMEX registered silver, the metal available for immediate delivery, was draining. When someone bought a futures contract and demanded physical, the exchange had to deliver from registered stocks. By early 1980, the Hunts and their associates had taken so much metal that COMEX inventories were critically low. If this continued, the exchange would default. It couldn't fulfill delivery obligations. The entire futures market would collapse, and that would trigger a financial crisis. Because banks, brokers, and investment firms had billions in exposure. COMEX had to act. And on January 7th, 1980, they did. They changed the rules. COMEX adopted Silver Rule 7. This rule placed heavy restrictions on the purchase of silver on margin. It effectively limited how many new futures contracts any single entity could hold, and it banned new speculative long positions, allowing only liquidation. This wasn't market regulation. This was rule-changing mid-game. The Hunts and their allies were already long, massively long, and now they couldn't buy more contracts to support prices or hedge their positions. They could only sell or hold, but they couldn't add, and the market knew it. Prices peaked at $49.45 on January 18th. Then they started falling, slowly at first, then faster. The Chicago Board of Trade implemented similar rules. Federal regulators opened investigations, and the narrative shifted. The Hunts went from being savvy investors hedging against inflation to being market manipulators trying to corner silver. Public opinion turned against them. Media called them greedy, reckless, dangerous, and the pressure mounted. By February, silver fell to $35. By March, $21. And the Hunts, who had borrowed heavily to finance their positions, faced margin calls. Here's how margin works. When you buy futures on margin, you put down a deposit, typically 10 to 20% of the contract value. If prices rise, you make money on the full contract value, amplifying gains. But if prices fall, you lose money on the full contract value. And when losses exceed your margin deposit, brokers issue a margin call. You must add more cash immediately, or they liquidate your position, force sell. The Hunts had borrowed billions to finance their silver empire. They had pledged oil leases, real estate, art collections, even Rolex watches and Mercedes cars as collateral. But as silver prices fell, those assets lost value too. Oil prices were weak, real estate was soft, their collateral was eroding, and the margin calls kept coming. By late March, they owed $100 million in a single margin call. They couldn't pay. And on March 27th, 1980, Silver Thursday, everything broke. Silver crashed from $21.62 at open to $10.80 by close, a 50% decline in one trading session. The biggest single-day collapse in silver history. And the Hunts faced a $1.7 billion loss. In 1980, that was the largest personal debt in financial history. Nobody had ever lost that much money that fast. The Hunt brothers, who days earlier had been worth billions, were bankrupt, or so it seemed. Except it wasn't just the Hunts at risk. Their lenders were at risk. Botch Halsey, Stuart Shields, their primary broker, faced insolvency. If the Hunts defaulted, Botch collapsed. And Botch's collapse would trigger a chain reaction. Other brokers, banks, investment firms. Over 20 financial institutions had extended credit to the Hunts, totaling over $1 billion. If those institutions failed, the entire U.S. financial system could seize. This was 1980's version of too big to fail. The Federal Reserve and U.S. Treasury couldn't let it happen, so they orchestrated a bailout. A consortium of banks, including Chase Manhattan, Citibank, and Manufacturers Hanover, provided the Hunts with a $1.1 billion credit line. This allowed the Hunts to meet their obligations, pay their margin calls, and avoid immediate bankruptcy. But the price was steep. The Hunts had to pledge everything. Placid Oil, their family oil company, real estate holdings, art collections, racehorses. Every asset they owned became collateral for the rescue loan, and over the next decade, those assets were systematically liquidated to pay creditors. The investigations followed. The Commodity Futures Trading Commission charged the Hunts with market manipulation. The Securities and Exchange Commission discovered the Hunts had failed to disclose a 6.5% stake in Bosch, their broker. Insider trading. Congress held hearings. In 1985, the CFTC formally charged Nelson Bunker Hunt, William Herbert Hunt, and their brother Lamar with conspiring to manipulate silver prices during 1979 and 1980. In 1988, a federal jury found them guilty. They were ordered to pay over $130 million in damages to Minpeco, a Peruvian government mineral company whose silver investments were destroyed by the crash. Each brother was fined $10 million. They were banned from trading commodities for life, and the IRS hit them with tax bills totaling tens of millions. By 1988, both Nelson and Herbert declared bankruptcy. Their estimated combined wealth, which had peaked at $16 billion in the 1960s, fell below $1 billion. Nelson ended up with less than $10 million. He sold his stable of 500 thoroughbred racehorses, auctioned his art, moved to modest circumstances. He died in 2014 at age 88, relatively poor by the standards of his earlier life. Herbert, more resilient, eventually recovered. He rebuilt through oil investments in the 1990s and 2000s. By 2015, Forbes estimated his net worth at $2.6 billion. He lived to age 95, passing away in 2024. Lamar Hunt, the youngest brother and least involved in the silver trade, became famous for founding the American Football League, which merged with the NFL. He died in 2006. The Hunt family legacy is complex. They nearly destroyed the U.S. financial system. They were convicted of market manipulation. They lost billions. But they also proved something critical. Silver can be cornered. Supply is finite, Concentrated buying creates exponential price increases. And if you can accumulate enough, you control the market. The problem is defending that control when the entire system turns against you. So what went wrong? Why did the greatest corner attempt in history fail so spectacularly? 5 reasons. First, leverage. The Hunts didn't just buy silver with cash, they borrowed heavily. When prices rose, leverage amplified gains. But when prices fell, leverage amplified losses. And margin calls forced liquidation at the worst possible time. If they'd bought only with cash, no leverage, no margin, they could have held through the crash. Silver recovered to $48 in 2011. They would have been vindicated. But leverage killed them. Second, visibility. The Hunts accumulated openly. They used their real names. They made public statements about silver. Everyone knew what they were doing. And once the market, regulators, and government realized the Hunts were cornering silver, they became targets. If they'd accumulated quietly through shell companies, offshore entities, hidden structures, they might have succeeded. But visibility brought scrutiny, and scrutiny brought intervention. Third, rule changes. COMEX changed the rules mid-game. Silver Rule 7 banned new long positions. This was unprecedented. It violated the fundamental premise of free markets. But COMEX did it anyway because the alternative was exchange default. And governments backed the decision. The Hunts sued, they lost. Because when a corner threatens systemic stability, authorities will intervene, always. The rules don't matter, survival does. Fourth, timing. The Hunts bought at the peak of 1970s inflation fears. By 1980, Paul Volcker, the Federal Reserve Chairman, launched the most aggressive anti-inflation campaign in U.S. history. He raised interest rates to 20%, crushed inflation, strengthened the dollar, and destroyed the narrative that paper currency was worthless. If currency stabilized, the panic buying of hard assets stopped. Silver's fundamental driver, inflation fear, disappeared. Prices collapsed. The Hunts were caught on the wrong side of a policy shift. Fifth, they took physical delivery. This was both their strength and their weakness. Taking delivery drained supply, created scarcity, drove prices up. But it also made them visible, made them targets. And once regulators focused on physical delivery as the manipulation mechanism, they had evidence. The Hunts' Boeing 707s flying silver to Switzerland weren't subtle. If they'd stayed in paper markets trading futures without delivery, they might have been seen as just big speculators. But physical accumulation was proof of intent to corner, and that intent became the basis for legal action. Now, here's the critical lesson. The Hunts failed, but they proved the concept. You can corner silver. The market is small enough. Supply is finite enough. Demand can be created through accumulation. Prices respond explosively. They got 90% of the way there. They reached $50 per ounce. They controlled 200 million ounces. They made $4 billion. And the only reason they failed is because COMEX changed the rules and the US government intervened. If the rules had stayed consistent, if markets had been allowed to function without interference, the Hunt brothers would have succeeded. Silver would have hit $100, maybe $200 per ounce, and the Hunts would have been validated as the greatest commodity traders in history. Instead, they became a cautionary tale. But the tale isn't, you can't corner silver. The tale is, you can corner silver, but you must be prepared for the system to fight back. Fast forward to 2025. The silver market today looks eerily similar to 1979. Structural deficits, 5 consecutive years. Industrial demand at records. COMEX inventories draining. London free float at critically low levels. China restricting exports. Sovereign entities positioning. And yet prices are just hitting all-time highs. Silver reached $64.66 in December 2025. Higher than the Hunt brothers' $49.45 peak, but adjusted for inflation, we're nowhere close. $50 in 1980 equals roughly $185 in 2025 dollars. We're at $65. That's 65% below the inflation-adjusted Hunt peak, which means either silver is undervalued relative to history, or the Hunt corner was an aberration driven purely by manipulation. I'd argue it's the former. Because the structural case for silver is stronger now than it was in 1980. Industrial demand is 680 million ounces annually. Solar, EVs, electronics, all consuming silver permanently. The Hunts face 300 million ounces of industrial demand. We face more than double that, and supply is tighter. Mine production is flat. Byproduct structure makes it inelastic. Above-ground inventories are lower than 1980. The fundamental support price is far above $65. But here's the difference. Nobody's openly cornering silver like the Hunts did. No individual is accumulating 200 million ounces under their own name. No billionaire is chartering planes to fly bars to Switzerland. The modern corner is more sophisticated. It's institutional. It's hidden. It's patient. And that brings us to the question. If the Hunt brothers proved that silver can be cornered, If the structural case is stronger now than 1980, and if prices are 65% below inflation-adjusted highs, who's positioning? Who learned the lesson the Hunts taught? Who's accumulating the way the Hunts did, but doing it better? Because someone is. The data shows it. COMEX registered silver down 88% since 2021. London flowed at critically low levels. Deliveries spiking. Lease rates hitting 40%. This isn't random. This is accumulation. Strategic, quiet, methodical. The kind of accumulation that doesn't trigger COMEX rule changes because it's not visible enough, not concentrated in two names, spread across entities, jurisdictions, structures. The kind of accumulation that survives regulatory scrutiny because it technically complies with every rule. The kind of accumulation the Hunts should have done but didn't know how. Now, here's what you need to understand. The Hunt brothers' story isn't ancient history, it's a blueprint. Every institution studying silver has read this story. They know what worked. Control enough supply, drive prices up, make billions. They know what failed. Be visible, use leverage, take on the system openly. And they're applying those lessons right now, accumulating quietly, avoiding leverage where possible, using corporate structures to hide concentration, and waiting for the moment when supply exhaustion becomes undeniable, when inventories hit zero, when industrial users panic, when the market realizes that physical silver is gone. That's when the modern corner completes. Not through a Hunt-style spectacle, through a silent squeeze, where prices rise not because two billionaires are buying, but because the entire market discovers there's no metal left. And by the time that happens, the accumulators are already positioned, already holding, already prepared. The Hunt brothers nearly cornered silver in 1979. They accumulated 200 million ounces. They drove prices from $6 to $50. They made $4 billion, and they failed because the system intervened. But the lesson isn't that corners fail. The lesson is that visible corners fail. Reckless corners fail, leveraged corners fail. But patient, invisible, well-structured accumulation, that succeeds. Because by the time anyone realizes it's happening, it's too late. The metal is gone, the corner is complete, and the price discovery that follows makes $50 look cheap. We've talked about the Hunt brothers, their strategy, their success, their failure, but we haven't talked about who's executing the same strategy today. Who learned from the Hunt's mistakes? Who's accumulating silver the right way? Quietly, strategically, with institutional backing and structural patience. Because someone is, the data doesn't lie, the inventories don't drain themselves, the lease rates don't spike to 40% without cause. Someone, or multiple someones, are cornering silver right now, and they're doing it better than the Hunts ever did. I've got a video on this channel that breaks down exactly who controls the world's silver supply. Not the Hunt brothers from 45 years ago, the modern accumulators, the entities that have quietly built positions so large they dwarf what the Hunts held. The refiners controlling metal flow, the exchanges managing inventories, the institutions whose names you don't know but whose positions dominate the market. When you understand that control structure, when you see the concentration, the Hunt brothers' story stops being history and starts being prologue. Watch that next. Because understanding what the Hunts did wrong is step one. Understanding who's doing it right is step two. And when you combine those insights, you'll see why the next silver corner won't end like Silver Thursday. It'll end with supply exhaustion, price explosion, and a market structure that makes the 1980 peak look like the beginning, not the end. The Hunt brothers proved silver can be cornered. They showed the path. They paid the price for being first. And someone learned the lesson. Find out who. Watch the video in the description and end screen video.